Welcome to CFO 4.0, the future of finance. The CFO role is changing rapidly, moving from cost controller to strategic visionary. And with every change comes opportunity. We are here to help you take advantage of this transition, to win at work, drive your career forwards, and lead with confidence. Join Hannah Munro, Managing Director of ITAS, a financial transformation consultancy, as she interviews key experts to give you real-world advice and guidance on how to transform your processes, people, and data. Welcome to CFO 4.0, the future of finance.
So hello everybody and welcome to this episode of the CFO 4.0 podcast. With me today is Danyaal Shah, who is the CFO of Nokkel. So welcome, Dan. Fantastic to have you on the show.
Thank you. Great to be on the show. And well, congratulations on all the success that the show has achieved.
Yeah, it's been a crazy year actually. 2024 has definitely been our biggest one yet. And exciting to talk to CFOs like yourself all about, your journey and you've come into the CFO world from a slightly different route to the norms. Tell us a little bit about your journey. How did you end up in your current CFO role?
Yeah, it's an interesting one, and the way that I see my job also kind of reflects, I guess, my journey. Because while CFO is usually kind of translated into Chief Financial Officer, I usually see myself as Chief Future Officer, simply because finance, while I've done enough of it, is not kind of where I add value. I add value because of the strategic insights that I bring. But my journey, so I started in investment banking when I came straight out of university. I was working in Singapore first, and then a couple of other countries, so Shanghai, Dubai, and then finally in the UK, mostly in advisory, so advising on M&A, and then at the last end or the last part of my career, mostly on fintech advisory, on M&A, capital markets transactions, capital raises, etc. That gave me a great amount of insight into kind of what investors look into, what companies need to kind of project outwards when they're kind of setting their internal accounting practices, etc., all of that, and how kind of doing the wrong thing early on can impact when you later get onto either capital raises or IPOs or M&A sales, etc. That informed kind of a lot into my next part of my journey, which was I was the head of M&A at a firm called FNZ Group, which is one of the largest fintech companies in the UK, at least now it is. And the very busy period, we did a lot of M&A, a lot of transactions and acquisitions. And I thought that at the end of that, I was now ready to kind of take on a more strategic role in a company like Nokkel, being more a startup going into a scale up. And kind of apply my skills as a generalist into kind of something more specialized. But at the same time, and Hannah, you'd know this, but at the same time, when you work for a startup scale up, you might have a job title, but you end up doing everything that needs to be done. So I double hat as a chief commercial officer as well. But effectively, whatever needs to be done in the company, somebody needs to do it, and sometimes that's me.
And from your, how do you manage, I guess, making sure that from a transactional perspective you're covered? Like, what's your approach to making sure that you obviously, you've got a lot of experience in that strategy area. How have you, I guess, filled the gap on the transactional day-to-day accounting, or is that something that you had absorbed, I guess, through your journey?
Yeah. So what I think the way that I portrayed it may have seemed that I haven't kind of covered. So number one, when you're an investment banker, you look at accounts a lot. It's bread and butter. I've also did an MBA and then a CFA after that, which kind of made me kind of drill down into accounting, finance, etc. And spent a lot of time doing modeling, cash flow projections, etc., LBO modeling, etc. Whatever was required in my day to day as an investment banker. My point there was that all of this, looking at ledgers, looking at P&L, balance sheet, etc., at a company in a company the size of Nokkel isn't a very complicated task. What where I add value is kind of looking at the next layer and can then deciding what next, or how does this impact us, or how will this impact us in the future. One thing that I don't try to do is macroeconomic forecasts, because I don't think they ever work. But on the micro level, i.e. the company level, we do try to project and to see how little things can impact the company. And more so because while a larger company will be able to sustain small changes, a company of our scale can get impacted quite substantially by things that are that may be very small for a larger organization.
And, given your history, you mentioned earlier that you'd seen some of the mistakes that businesses make along the journey, and some of the ways that things go wrong. So tell us a little bit about that. Like, what are the lessons that you've learned from that time in investment banking and M&A, and in terms of how it's, I guess, made you think about how you're growing Nokkel?
Yeah. So as a small company, it's very easy to not, kind of pay or pay attention to or have emphasis on processes, procedures, how you record things, making sure that you keep, good records of everything, using good systems, good practices. And it's easy to not do it when you're small because you don't need to, including, for example, if you're having a board meeting, making sure that, you keep good board minutes, etc. All of this goes in data rooms and due diligence, packs when you, let's say, do a capital raise later or IPO, whatever that might be. So making sure that you're prepared for all of that and keeping the books clean, not having to do too many adjustments, but kind of, thinking through how these will impact the company. All of this kind of, things that I think about on a daily basis. I always think about, well, if we do this now, how will this look when people look at this in 3 years' time?
Yeah, and that's that concept of a data room. I had a few conversations recently with Jeremy, who's one of the CFO coaches we talked directly on the podcast, and he very much said that when you go into that sort of acquisition, be actually controlling and having that detail, almost thinking ahead of where you want to be in terms of what data do you have at your fingertips, how quickly you can respond to questions, was critical to the success of a merger and acquisition. And from your experience, what other things are critical to set yourself up to be acquired? What sort of things should you be thinking about nice and early on, so that you can go into that process when and if you're ready?
Also, emphasis on revenue and the type of revenue that you have. Investors like revenue that can be, repetitive, basically recurring revenue, or business that, kind of is dependable. People invest in the future, not in the past. Even if you've done well in the past, but you can't repeat it, that's something that, people do pay a lot of attention to. We're also coming into an environment where there's a lot of emphasis on, well, all good and well that you're making a lot of revenue, but is there a path to profitability, and when do you get there? And so things like that. So what that translates into is a lot of cost control, even in a business our size. A lot of founders, kind of, and rightly so, pay all their attention into kind of building without realizing that, well, all of this cost, you have to justify this at some stage. And if the business becomes too expensive, say at any point, you will get scrutinized for that, and you will have to explain it. Not all the time, your explanations are, or your justifications are taken as you intend them to be. So the cleaner that we can keep at the moment, the better it is. And kind of just making sure that all of this thought feeds into the business without killing or without kind of suppressing kind of the needs of the business today. Solution focused rather than just saying no to them.
And that's really interesting. Have you got examples from your history where that's been a problem? Specific examples that you could share with us?
Without going into specifics, so things like for example, the tech team or the product team or whatever will have lots and lots of kind of reasons to do a lot of things simultaneously, and then you have to ask them to prioritize. Because if we could do everything together, we would. And if you throw money at problems, it's very easy to kind of build things that you don't immediately need. The question then has to be, well, do we need it now? Does it have to cost what it costs? And kind of, is there a better solution? So what I usually try to do is, if somebody comes up with something that the company needs, I usually say at least get 3 examples of alternatives that we can look at. And then we can talk about kind of which one's the best for us, and how that would kind of not suppress what we're trying to do, but at the same time will not be kind of the most expensive way to do it. You may have done it in a much bigger organization, and that might have been fine for that organization of that scale, but for us, at the moment, do we actually need to spend this much money on this?
And I guess what so this is really great insight. What other lessons have you learned from being on the other side of the fence that you bring to your CFO role?
Yeah, so I mean, the one thing obviously is kind of how investors look at things. The other is how boards look at things, and also kind of it's very easy from an from a founder slash company perspective to be entirely product focused and be or live with the idea that build it and they shall come kind of thing, right? I have seen this firsthand. I've seen companies where they do that and don't actually test the demand. I don't run sales or kind of the customer side of things together. Um, and that has been an emphasis at Nokkel in general, also because my CEO Roland, he also comes from an ex-investment banking background, but also him and I talk about this all the time, and we were very focused on the fact that anything that we're building, anything that we're spending our time on, yes, it might seem like a great idea for us, but we have to test it both with the customers and with the market at the same time to make sure we don't spend resource, time, etc., in places that are not kind of where we where we think they should be. Having said that, I mean, Henry Ford did say that if I asked people what they wanted, they would have said they all wanted a faster horse. So we have to be cognizant of the fact that people don't always know what they want, but at the same time we try to find ways to test with our customers, with our clients, what they may need, and tell them what we're thinking, and then see how they react to that.
And how do you, because one of the key roles of CFO is making sure that they understand the allocation of resources within a business. So how do you go about, I guess, planning and prioritizing that resource and allocation? You mentioned obviously customer feedback. What's your approach in terms of how you decide the future value of an investment?
Yeah, so a couple of things. So number one is we spend a lot of time kind of looking at where we are spending the resource, both through our budgeting / planning process. We do a lot of budgeting and planning for the size of the business that we are. We spend a lot of time doing the business plan and the budgeting, the planning, etc. A lot of it's still on Excel because obviously there is a kind of a tipping point at which using the tools that we would want to use for automation for all of this become feasible. But at this time, the expense is not justified by how much productivity we'd get out of them. So at the moment, a lot of this is still on Excel. But having said that, all of that planning on Excel still helps us a lot to make sure that all of the resources that we allocate are allocated in the places that we thought they would be allocated. Because sometimes you plan something, by the time you actually kind of get the allocation, things have changed. So we regularly look at kind of where. The other thing is we do allocate costs internally into kind of buckets through our accounting software to make sure that we can track them, and then we do a regular kind of check back to ensure that the way that things are panning out are as we planned.
Now, for the £1 million question. What is the best finance software for your business? Is it A, Sage 50? Is it B, Sage 200 Standard? C, Sage 200 Professional? Or D, Sage Intact? An impossible question to answer without a lifeline. But we have the perfect lifeline for you. Our free quiz, which Sage product is right for you? We'll tell you which product is the best fit for your business in just 5 minutes. All you need to do is head to www.itassolutions.co.uk and answer a few simple questions.
And what is that planning cycle? Because obviously it's a smaller business. How frequent is that planning cycle?
So quarterly, I would chat to the heads of our departments, head of engineering, head of product, etc. Make sure that they so first part of this exercise would be they'd speak to kind of their line managers, bosses, etc., the CEO, to make sure that they have agreed what their objectives for that period are, and then based on those, then they will come up with a plan and then ask or communicate to me this is what they need in terms of resources to make sure that plan is carried out properly. My job is to question everything that requires an expense, and ask them to justify it. Then I also ask them to kind of come up with alternative ideas where necessary, and then we run an approval process for kind of making sure that every bit of the budget is approved. What sometimes happens is somebody will give you a budget of, let's say, X for something, and then you actually get the bill and it's X plus Y. Then you have to ask them to justify why this happened, and sometimes there's a good reason and sometimes there's not. But it's controls like this that ensure that we remain funded for the period that we thought we would be funded. We get to profitability when we need to get to, or when we want to or plan to get to profitability, and we don't kind of come into problems that we haven't foreseen.
And I was talking on a previous podcast about the importance of accuracy when forecasting, particularly when you may be going into being acquired, because it can sometimes be a topic of conversation. How do you approach forecast accuracy, and have you figured out that secret sauce to make sure it's not it's right, or are you still figuring that out as an organization?
Yeah, so I mean, I'm going to quote Howard Marks here, because and when he talks about kind of forecasts can never be extremely accurate. So anybody who forecasted before, let's say 2007, 2008, didn't forecast for the financial crisis, right? And if anybody was, then they would have been forecasting to a zero. Now, I mean, even the worst case scenario that people forecast, nobody forecasts to a zero. But there is a worst case scenario where things do go to zero, right? And that's always possible. But you never forecast for that. So there are things that are in your control, and you try to kind of forecast for that. But there will always be things that are outside of your control. There's always kind of negative surprises that kind of come up unexpectedly, and you can't forecast for that. We try to do our best in terms of kind of what we know. We're also not extremely pessimistic, because, like I said, extreme pessimism means, well, nothing happens and you make no money, and you go to zero. And whenever somebody says to me the worst case scenario is this, well, clearly there's always something worse that can happen. You just don't want it to happen, and hopefully it wouldn't. But yeah, within the bounds of, well, not too optimistic and not too pessimistic, we try to kind of come up with realistic scenarios, and then based on that, hopefully these bounds hold. The key there, to answer your question, is making sure that you have a range in your modeling, so that you have scenarios to kind of know what the bookends are.
And from your investment banking days and your piece in terms of M&A, has that changed how you do forecasting?
So, like I said, the one thing that very few people now pay attention to is macroeconomic forecast. Once upon a time, people used to pay attention to, well, how would the GDP grow, and all of that. And people realize that that has no impact whatsoever on a company's performance, because the market is cyclical, and there'll be highs and there'll be lows, and over a time period that will get evened out. Or it's not in your control and you can't predict that. What people do pay attention to is the fundamentals, or the rudimentary kind of things that make the company. And if the fundamentals are strong, and the market that you are kind of going after, so, what's your target, total addressable market, what's your target market, what's your customer acquisition cost, things like that, people pay attention to. And so long as you've got that figured out, and you can answer those questions, or have incorporated those questions into your modeling. And the other thing is that KPIs. How do you track your performance? And if your business is unique, or has certain characteristics that make it unique, like Nokkel, you have to come up with KPIs that address that uniqueness. It can't be the typical, yes, everybody looks at ROIs and ROEs and all of that, but what beyond that? How do you track things like how your customer acquisition is going, or how people are interacting with your platform, etc., or how you're tracking progress, growing customer wallet, etc., stuff like that.
And when you're thinking, I guess, about positioning yourself for growth, how do you think about what's the right pace of growth? How do you look at where to set your goals? And like you said, what's realistic versus what's not?
That's a good question, because look, growth is difficult to track and growth is different for every business, right? We might be happy with, let's say, a 20% or 30% growth in the first few years. Some other businesses might think that's too much. Some other businesses might think that's not, kind of enough. All we kind of want to track at the moment is we are constantly growing the number of customers that we engage with. We are getting more engagement with our product. The use of the product that we're putting out is increasing, and we can we can get more both pricing power. Yes, yesterday people were willing to pay X for our product. Today, if we wanted to charge more, can we charge more? Not saying that we will, but do we have that amount of control over our product? And then, is the volume still growing? Are we still kind of getting into new markets, etc.? Things like that is what we track for growth, or aim to track for growth. But other than that, look, I mean, it's still, at the moment, the market that we are addressing is still so large, and we're kind of still scraping the surface, that worries like that haven't kind of really seeped into our fundamental assumption at the moment.
And the term path to profitability has become really common, especially last year or so, I think, with the change in the market. What's your view on how to do that well? Again, sort of playing on your background, what do you think the investors are considering when they're looking at a business that isn't profitable?
Yeah. So look, I mean, at every round of funding that you do, you make some promises to the investor, right? And you put out a pitch or your investment documents or whatever, and you say, with this amount of money that we raised, we plan to do X. The first thing that you have to make sure is you achieve what you promised, and then the next time that you are looking for more money, you kind of make promises that you aim to achieve. And so long as you keep doing that, you have credibility, or you're kind of you're doing what you're saying. So that's one. The other is, look, I mean, the reason why path to profitability has become so expensive is because money's become expensive. Interest rates have gone up generally, but also kind of that period of very, very cheap financing, which we were in right after COVID, has disappeared. And with that, now you have to the hurdle to clear is much higher. So everybody's talking about, well, we can't wait forever. We want to see when we start getting some of our money back, and that's absolutely all right. But there's two things that make up the bottom line profitability. One is obviously your revenue. Yes, you need to kind of keep growing your revenue, and you need to have a story or a path that continues to keep growing your revenue. But if the costs are outpacing revenue growth, then you would obviously be making less and less and less money, if not a loss. So keeping an eye on costs has become extremely important in our environment. Something that was almost absent, let's say 5, 6, 7 years ago.
And we mentioned earlier customer acquisition cost, and I think, like you said, if you want to continue to scale, understanding that payback period is really important. Tell me how you look at assessing again, both your own, but also businesses that you sort of looked at investing in. How do you assess whether their customer acquisition cost is where it's need to be, and what is it that you're looking for and to get to?
Yeah. So let's say your revenue target or your revenue metric that you track for a customer is like something like what Amazon does, which is ARPU, average revenue per user or whatever. If your average revenue per user is not justified by how much money you have to spend customer acquisition cost per user, if you're making £10 per user, but you're actually spending £9 to acquire that user, then your actual profit for that user is just £1, right? And that's something that you have to be very cognizant of. Sometimes the CAC, or the customer acquisition cost, exceeds what you actually may end up making on a user. And so you might have great user numbers to show, but all of that funding that you're raising, or all of that money that you're spending on acquiring customers, is unsustainable, because the acquisition of a customer is so expensive that unless you keep spending more money than you're making from that customer, you're not going to kind of end up growing the business. So this growth has to be justified, and it can't be through basically spending more money than you actually spend, end up making it for a customer. It's tantamount to, well, standing outside your shop and giving people money to spend in your shop and saying, we'll pay you £12 so you can spend £10 in the shop. That doesn't work, right?
And I guess what advice would you give to a CFO that's wanting to make sure that they are going to look good in front of an investor, or going out to raise capital? What were some of the things that you think they should consider?
Well, I mean, you really need to challenge your product, your commercial, your management and senior team, to say that what is happening right now, if that is happening, if you're spending this much money acquiring, this is not sustainable. You need to come up with a better plan. This is not a sustainable plan, and it might make you think that we are doing the right thing or having the right metrics, but these are not the metrics. People are now too smart to just look at customer numbers. People now look at the next layer, and what you're trying to achieve from this is not getting achieved. We need to find a better way. If you do that early enough, and you don't kind of go down a path of wasting a lot of time, a lot of money, and a lot of effort, and come up with a better plan early on, then you'd save a lot of both money and a lot of headache for everybody involved.
And when you mentioned that people are smarter now. When you were working on the other side of the fence in the investment side, how often were you coming across, finance teams and finance leaders that weren't able to give you the numbers in a great way? Is it a common challenge, or?
So yeah, it used to be a common challenge. There were a lot of VC investors that would invest simply based on the promise of a future that was not justified by the numbers, customer acquisition costs being too high or whatever. There are many examples that I wouldn't name because they're very, the company that still exists, etc. But there were many companies where the customer numbers were growing very, very fast. But their revenue was 30,000 customers, £30,000 in revenue. But something not working out. You're a neobank, right? I mean, you need to be making more money than that. Things like that. But large investors, large VCs, a lot of them based out of the San Francisco Bay Area, etc., were investing big amounts of money into these companies simply because for the promise of the future. And the question at that point in time in my head was the same as it is now, except this question is now kind of what everybody's asking, which is, well, where's the sustainability in this? This business model doesn't work.
Yeah, and I think that's interesting. It is almost it seems obvious in common sense, but it's amazing that it's actually taken the change, I guess, in the cost of capital to actually address that imbalance. And I think that's what we've seen over the last year or two is kind of that market writing itself, and starting to ask those questions. And what do you think is the biggest challenge facing companies that are going out to raise capital at the moment?
Well, number one is capital is not that easily available. You have to tell a much better story, and you have to be credible. You have to show a lot more than you had to previously. The other thing is debt, because it used to be cheaper. You could fund yourself with cheap debt, and that was sometimes kind of a stopgap or whatever. It's very interesting, but if you think about this, no company ever went bankrupt when they didn't have debt. What bankrupts you is debt. If you raise debt that is too expensive for you and you can never pay it back, that's how your company goes under. Some companies don't realize that, and then kind of it becomes a noose around your neck because all you do is you keep having interest payments that you can't meet, and then the money that you are raising is now to facilitate these debt payments rather than to actually facilitate your growth. Investors are now cautious of this, and they don't want to give you money just to pay back your debt. So keeping a clean balance sheet, making sure you remain clear to your ethos and don't have to change direction too often, because people read your story and make sure that you haven't kind of adjusted it because the last one wasn't working and there's no guarantee that this one would either. And then keeping, like I said, books, records, etc., clear, clean, because it's very easy to spook investors if something looks out of even if there's nothing that you're hiding. If it looks like you are, it gets very difficult to justify.
And when you say even if you're not, but it looks like you are, what are some of the things that can give, can spook an investor? Can you, like, without talking about a specific company, can you give us some examples of what you've seen in the past?
Yeah, so if there's lots of restatements in your accounts, well, why? And why do you need to do that? If your R&D claims and filings, for example, keep changing, or there's a lot of fluctuation, why is that? What if you need to capitalize and then kind of reverse those capitalizations or whatever? All of these things, reasons for why all of this is happening, right? Or if your board minutes seem like they've been edited or whatever, why have they been? What's missing? Or if there were things discussed at the board that haven't been edited, but is still kind of raising questions that aren't fully answered. Very difficult to answer questions that either you may have forgotten the answers to because it's been such a long time, or you may remember the answer but you still can't fully justify it because it looks odd on a piece of paper in the minutes or whatever. A lot of these things kind of do impact kind of how investors look at and or do get spooked by these things.
Yeah, and I think that's a really great. It's almost that. Do you feel like the sentiment has changed, that now they're looking for reasons to say no rather than reasons to say yes?
Yeah, I think that's probably right.
And we've talked a lot about, investors don't want to necessarily, they're not interested in paying off debt. They want to make sure that you're growth focused. How do you look at debt and cash, your future forecasting around cash flow and finding the right balance in terms of not, like you say, overburdening yourself with debt, but making sure that you have what you need to move forward?
Yeah, and I think you hit the nail on the head when you match debt with cash flow. So what pays debt is not your EBITDA. What pays debt is your cash. So you need to be the first thing you need to make sure that you're generating enough cash to be able to pay your interest payments or your debt payments or whatever. If you're not, even if you're EBITDA positive, but your cash flow doesn't match, you will still need to come up with that cash to pay that. And sometimes that becomes a huge problem for a company that hasn't thought this through. The other thing is, look, after EBITDA, you still have to make a lot of other payments, including obviously interest and tax and all of that. And yes, leverage is usually a multiple of your EBITDA or whatever, but you need to make sure that your cash cover is confidently covering all of your interest payments. Debt providers have become more cautious, but not to the extent where they will not give you debt, right? The one thing that I recently heard, which kind of really kind of resonated with, was a leading UK debt provider talking about, well, you'll always get your money back so long as your borrower is worth more than your debt. Well, that is true, but the way that they're thinking about this now is, well, so long as you can recover that money from the borrower, no matter what happens to the borrower, your debt is good. But where does that leave the company raising the money? And you have to think about kind of if you're comfortable, and obviously I'm not saying debt is a bad thing. For some companies, it's necessary at the right stage. But if your cash flows, your income, etc., are not at a stable level where they're predictable, etc., then debt can be something that kind of becomes very difficult to manage.
And very expensive as well, because obviously if you're high risk, it limits your access to certain types as well.
Yeah.
And so, was there anything that I guess surprised you moving into this CFO role? Was there anything that you either didn't realize or that sort of came out? It wasn't something you expected when you first moved into the CFO role?
Yeah. I wouldn't say surprised me, but something that kind of has been, I guess, almost a positive surprise is how I would put it is that. And they say this all the time, but it's lonely at the top. And so when at the level of the company that I'm at, and specifically my CEO is at, we only have each other to talk to sometimes, about a lot of things. And so kind of he sometimes sees me as his voice of reason, and kind of vice versa. But a lot of times when there are things, you only have yourself and your CEO to talk to, because that everybody under sometimes cannot be privy to a lot of things that are being discussed at that level. So that's something that kind of I hadn't experienced before, because at every level I'd had many people that I could talk to, especially in larger organizations, etc. But yeah, I mean that's been a good learning kind of challenge, where you have to now trust your instinct, your gut more, because well, there's only one other person that you can check with.
And what advice would you give to, maybe there's someone out there that wants to move into, like you say, the CFO specialism? Perhaps they don't have a transactional finance background and are wanting to make that shift. Tell us about, have you got any advice for them in terms of things to consider?
Yeah. So number one is you have to be very decisive, because people will challenge you, and you have to kind of be able to stand your ground. Number two is you have to be willing to listen to reason, but the reason has to be good. So you have to you have to give people a chance to convince you, but not get convinced every time as well. So you have to kind of know your stuff well enough, so that people, when they challenge you, you have an answer. So long as then maybe there's something you haven't thought about, then willing to kind of take in feedback, etc. And then make sure that you develop your soft skills as well, because they're very important, because well, like I said, there's no other checks and balances, and you have to check yourself.
And I think that's really good, especially I think in a smaller business, you need to, like you said, you've got less of the checks and balances above you in order to keep you on track, in terms of rounded is the right word. And I guess, top tips for building, investor friendly forecasts and cash flows. What are some of the things that you would say to anyone that knows that they're going into an investment round in the next 6 to 12 months? What do they need to be thinking about now to make that a success?
Yeah, I mean, I can tell you what my approach is, which is try to be honest and kind of as accurate as you possibly can be, given what you know. If you're too optimistic, you wouldn't be able to justify it. If you've done 10% growth over the last 3 years, and you're all of a sudden projecting 50% over the next 3 years, well, you have to have a very good reason to be able to do that, right? You might have come into a windfall of some sort, and there might be a reason to believe that that's happening, but that reason needs to be really solid, not just that now we will put in more effort and this will happen. That just can't be it. The other thing is, from our perspective, so we've applied for a number of FCA, which is Financial Conduct Authority permissions. That means that we are going to come under the scrutiny of the Financial Conduct Authority very soon, and so we have to pay extra attention to making sure that everything that we put out in front of the investors, into the market, etc., are well whiter than white. And so we try to follow that principle into everything, and I guess that's served us well so far.
Fantastic, and some great advice there for those that are both looking to go into investment, and maybe those looking, and not just those looking to make a switch from a non-traditional, but actually I think a few new CFOs could take that advice on board in terms of top tips. Now, so one of the things I haven't asked you is, in terms of, if people want to learn more about Nokkel, about yourself, Dan, and what you guys are about, where is the best place to find you?
So to learn more about Nokkel, the Nokkel website is a great resource. So that's nokkel.com. And to learn more about me, you can find me on LinkedIn, Danyaal Shah. I think I should be fairly easy to find.
And absolutely. And of course, guys, anyone that wants those links, don't forget, we'll pop them in the show notes so you can find Dan's profile really easy. Well, thank you so much, Dan, for taking the time to talk us through your journey. And I guess it's been great to hear a different perspective from the investment side. So thank you for sharing it with us. It's been great to talk to you.
Thank you. Likewise. Very good to talk to you.
So if you've enjoyed this podcast, and maybe you've got some ideas or thoughts about the next show that we run, so I'd love to hear them. So don't forget not only to check out Dan's profile on LinkedIn, but send me a message as well. What topics do you think we should be covering next time on the CFO 4.0 podcast? So for me, one of the most important things about any transformation project is the partners that you work with. And whilst I'd love to list off a whole host of reasons why ITAS is the perfect partner for your transformation project, why don't I let our customers do the talking for us?
One really good thing working with ITAS is it's dramatically reduced my blood pressure. Obviously, an account system is critical to anyone's business. So innovation data, without that, like every company, we couldn't function as a company. So, it's one of the most critical pieces of software, and any sort of vulnerability we have with that sort of keeps you awake at night. And now working with ITAS, I don't have any concerns about our accounts functionality and our account system and the usability and all of that. Working with previous partners, I've got some grey hairs and sleepless nights from that, as I say, because it's so critical. So it's been an absolute pleasure, and long may the relationship continue.